Ray, investing in China can be a risky thing to global investors. That's the way they perceive it. How do you think about that relative to the other risks they're already carrying in their portfolios?
I think that every place is risky. And so we're talking about relative risk,
Yeah.
okay? I think Europe is very risky when monetary policy is almost out of gas and we have the political fragmentation and they're not participating in the technology revolution. And I can go on and on as to why I think Europe is very risky. I think the United States is very risky in its own ways, having to do with the combination of the wealth gap, the political system, the conflict between socialism and capitalism that'll be part of our election, the fragmented decision making, the so many different things, and the absence of the effectiveness of monetary policy when we get to be operating that. I think emerging markets in their own ways have their own distinct risks. And I think that China has its own particular distinct risks, which are all different. And I think when I look at it, I think that it's less or no more risky in the totality than other markets. And I think what is most risky is not to have a good diversification of those markets. In addition, the Chinese have more ability to deal with monetary and fiscal policy relative to the United States. I'm not saying everything's a plus. There are pluses and minuses. But as you know, one of my big concerns, and I've got a number of big concerns about the West, the United States, and some of the issues that are facing the Western economies. And among those are the inability of central banks to be as effective when interest rates get to zero and quantitative policies, quantitative monetary easing, is not as effective. So let me pause on that and touch on that. If you look at the difference in interest rates to zero and the capacity of fiscal policy to be coordinated, they have a lot more room to be managing those things, and they are managing. I mean, if we, I don't know how long I've heard, everybody say, okay, the debt problem is going to be a problem there, and so on. Again, I'd suggest you read the dynamics in my book about the nature of debt and what countries can do when the debt is in their own currency. I also think that not investing in China is very risky. I mean, think about it. Here we are in the early part of the 21st century, and there's this emergence of China. Do you really want to make the decision not to invest in China and not to be there in the future? Look, I believe every place is risky. I'm very risk focused. I tend to see things that are going to go wrong. I have an inclination to do that. So I think every place is risky, which is why I like the notion of diversification. I just want people to see China objectively. Like I know over this past number of years that I have been very pro-China, very bullish on China in its various ways. And people say, why are you so bullish on China? And I know it's very controversial to be, particularly at this time, right, to be very bullish on China. I just want to let you know that I'm sincere, okay? I've been there because I hope you know by now that my main objective is to be as accurate as I possibly can. Yeah, I really admire what is being done, and I want to be a part of it, and I think our investors should be a part of it.
I want to ask you about the best way to actually invest in China. What we see is that most of the portfolio flows go to either the private equity markets or the public equity markets. And that's a little counter to how you've sort of, your framework of how you invest across time and throughout the world. How would you think about best approaching the Chinese markets as a new investor?
Well, I wouldn't think of it as being any different than in any other place. There's a the public markets are, and the liquid markets are going to allow all the advantages that they allow, and the private markets are going to allow all the advantages that they allow. The public markets are going to provide the liquidity, the diversity, the ability to move positions around and rebalance and so on, which is very important to us. And then the private markets, let's say the venture markets, expose one to the new technologies and the energy that's happening in terms of entrepreneurship and young technologies there. And I think that's important. I think there's an awful lot of money that is chasing those venture capital investments. And then I think there's a whole lot of opportunity. I would say it's a reflection really of how that country has changed. Wow, from my $10 calculator days and to see what the mind-blowing technologies are. To put that in perspective, they're now number one country in fintech, number three in AI and machine learning, number two in wearables, number two in virtual reality, number two in educational technology, number two in autonomous driving, and they are running fast to be number one in those industries. They now account for 34% of unicorns in the world, by comparison to 47% in the United States, and only 19% in the rest of the world. And in terms of, that's when they start as unicorns. If they take the share of unicorn value, it's 43% versus 45% in the United States and only 12% in the rest of the world. So if you're looking at venture, I think you've got to be there. So I think it would be important not to miss out on those. As far as the public equity situation, it's analogous. You could see the market capitalizations accelerating in the stock, bond, corporate bond markets, all of their instruments. And you could see the foreign flows coming in at an accelerating pace. You can expect those markets to be bigger than the markets that we have in anywhere in the world with time, and they will serve a similar purpose. So as far as, let's say, the legal regulatory system, it's advanced, but it hasn't advanced as much as some of the developed countries, but it is more advanced and developing at a fast rate than most of the emerging countries. And if you deal with the question of whether it's a more autocratic system and whether you prefer a more autocratic leadership system than a democratic leadership system, you'll have to make that choice for yourself. Don't look at it as some unique place in terms of some of those impediments. Look at the whole picture. I would say that the Chinese or Confucian way of approaching things has a lot to be said for it. So you have to make your own choices.
Let's get back a little bit to some of the questions that investors have. For example, should they think of China as an emerging market investment? Should they think as a developed market investment, somewhere in between, in terms of the expected return, risk, correlation of that investment? You talked a little bit before about diversification, but what about the expected return and risk of an investment in China, and how would you structure that?
When you ask me the question of it, is it more like an emerging country or more like a developed country? So many different aspects of what defines an emerging country or a developed country's market vary. Okay, so they race down. What is the size of the market capitalization? What is the legal form? What are property rights? Mm-hmm. You know, just so many different dimensions. But I would make as a generalization that China is somewhere between 60 or 70% more like an emerging country, 60 or 70% more like an emerging country in those respects than it is like a fully developed country. But it has good, it doesn't have a regulatory system that is as developed as the developed countries that have been at it a while. It doesn't have some things. It has market capitalization. It has liquidity. And that's a two-edged sword. It has also greater levels of inefficiency. So the greater levels of inefficiency provide investment opportunity. So as a generalization, I would describe it that way. If I'm looking at it instead in the question of expected returns and risks, I think, as you know, I look at each market and I look at the return relative to the risk, the expected return relative to the expected risk, and the past return relative to the expected risk and what drives it. And by and large, I find developed markets and emerging markets roughly comparable, and that being able to put together portfolios of those in an effective way is the way to engineer that portfolio. So when I look at China, I think that the expected return relative to the expected risk will be equal to or perhaps higher than elsewhere, partially because of the fact that there's the diversification that you could have and put together well, but also partially because of the greater capacity of the central banks in the central bank, I should say, in being able to ease monetary policy and also run fiscal policy to be able to have higher ratio. I think that would be a plus.